Good afternoon, everybody. Uneducated Economist here. I was reading an article, actually two articles, one of them out of Bloomberg, the other one from Wolf Street, talking about junk bonds and the zombie corporations that are out there. And it turns out August was the second highest month for junk bond sales and the highest August in history. But last July, and August are the two highest months for junk bond sales. And I think about this, these low interest rates are causing a zombie apocalypse to take place. In fact, if it continues into the next couple of years, I could assume that there are going to be so many zombie corporations around us that we are not going to know the difference between a good company and a bad company because they are all going to be suffering under the same amount of debt load. It, right now, there are fixed income investors who want to put money out there and get a guaranteed return. And government bonds were typically the safe haven place to go, okay? Because years ago, many years ago, you could get, up into the teens, where it comes for the interest rates that they would pay. But even back when they would pay 5% interest, they were still a safe place to put your money. You could get a return on it. You could invest in nothing but these bonds and get a return for your entire life and have a decent amount of money at the end of it. But now these bonds, they don't pay. The yield on them is so low that buying a bond or a government bond is pure speculation. You're anticipating that the interest rates are going to go down into the future and you'll be able to sell that bond for a profit. But to purchase it for the fixed income is almost pointless because there's almost no return on like a 10-year bond. So these fixed income investors, instead of looking towards the safe haven of a government bond, they are now seeking out the return of junk bonds, zombie corporations. These companies that would never have existed in the first place if it wasn't for the fact that they have investors seeking out that higher yield and willing to lend them money so they can continue on. This is a scary situation because when you think about this, if these companies didn't exist, if they were not there, that money would float in another direction. It would flow towards a proper investment. Okay, because that's typically an investor would look at something and say, hey, that's a good idea. You got a good service, you got a good product there. I'm willing to give you some money, postpone reimbursement for a while to see if this investment, this product and service that you're providing is going to perform. And if it does, the return that I get will be that much more. Okay, that's pretty simple as an investor. But when you're looking at these zombie corporations, you're just chasing this yield. You're just looking at it saying, okay, I need that yield, so I'm willing to loan money to this poorly credit rated company so that I can attempt to get that return. And that capital that should have flowed to a proper investment is now flowing to the zombies, where they just gobble it up, eating all the profits, eating all the best talent out there. It's just sucking it up. And we got a couple of years of this ahead of us, according to the Federal Reserve, because they are planning on keeping interest rates low for the foreseeable future. It's going to produce even more of these zombie companies. Why wouldn't it? If you can just sit there and gorge on debt and survive, why wouldn't you make that part of your model, especially if the Fed says they're going to do it? And a lot of people look at this and say, yeah, the Federal Reserve is buying up these corporations, these companies. That's not necessarily the case. They have the special purpose vehicles, they have purchased some corporate debt, but they were pushing to get the investors to front run them. That was the whole point of the special purpose vehicles and the lending facilities to buy up corporate debt, is that they don't really want the corporate debt. They just want investors to front run them and buy up that corporate debt before they have a chance to, anticipating that the Fed is going to go in there and the interest rates will drop and then, they'll be able to sell it to the Fed essentially for a profit. We're going to come into some really scary situations. I just try and think about what the housing market is going to be like with the lumber prices the way they are. That's going to be really disruptive to the markets. But when it comes to interest rates rising, you ain't seen nothing yet. If the interest rates start to tick up, we're going to see zombie corporations start to fold as the debt burden becomes too much. And if they go to repay it and they don't have the production or service that's profitable to pay back those bonds, that's, you can start seeing some bad times, you know? So when they say like the interest rates cannot rise, well, I wouldn't hold your breath. Okay, interest rates can rise. At some point, investors just get fed up, and then the Federal Reserve could step in and just, and buy up everything. But then the dollar just becomes, pretty much worthless. I mean, this is the dilemma that the Federal Reserve is now in. Weaken the currency to non-existence, or you let the interest rates rise and let some of these zombie corporations start to fall, so that true capital or capital can flow into real investments, into true talent, not this entity that just pretty much just consumes and does nothing else. A lot of people are going to suffer. The investors who are seeking out that higher yield, if they have exposed themselves too far out there, they've put too much of their capital towards those high yielding debts, and we see a turn in the economy and interest rates rise, it's going to be a bloodbath. The way that they describe the bond market, it's a highway going in and a goat trail going out. Because when the sell is on, there is no buyers. All right. Uneducated economist, you guys let me know.